Shares of Yes Bank plunged 27% in the early trade today after the company reported weak set of numbers for the quarter ended March 2019, and most brokerages downgraded the stock. Let's do a three-point analysis of what went wrong for the Yes Bank in Q4 and what should be investors' strategy now. 1. What led to the poor performance of Q4 earnings of Yes Bank? Well, the company has reported a net loss of over 1,500 crores in Q4 on the back of spike in bad loans. Core performance was weak, with loan growth decelerating to the teens and interest margin contracted 30 basis points year on year on interest reversal as assets also slipped into the non-performing pool. Corporate fees for Q4 were negative on account of an income reversal of 280 crore rupees as the bank also adopted a prudent accounting policy and decided not to recognize certain fees upfront. The bank also made an ad hoc contingency provision of 2,100 crores on low-rated standard assets of close to 10,000 crore rupees. Now, higher provision resulted in a spike in credit cost. The management has also guided at an elevated credit cost in FY20 and also expects normalization only by FY21. Q4 also saw a significant rise in slippages to NPAs of the order of 3,400 crore rupees. That also includes exposure to an airline and IL&FS. 2. What's the outlook on Yes Bank? Well, the bank's liabilities profile is clearly a weak link. The new leadership wants to hear a resounding yes from the regulator. It is working to be on their right side by adopting superior risk management and the highest standards of corporate governance. A focus on retail, both on assets as well as liabilities, with more cross-selling, decentralization of functions, and making branches profitable are high on the agenda. While the growth may be cleaner, it will certainly be more moderate, with the new leadership guiding at a growth in early 20s as opposed to mid-30s in the past. Now, the new leadership also plans to raise a capital of close to $1 billion. 3. What should be investors' strategy now? Well, near-term earnings will be weak as the transition plays out, so stock may consolidate post-correction. Should the bank succeed in convincing the investors that it is going to be a clean as well as profitable journey in the medium term and also get the requisite capital at a decent premium, the stock might re-rate earlier than the financial turnaround. But this is a million-dollar question. However, in the long term, the bank is likely to come out of this crisis, so a weak phase might provide a gradual accumulation opportunity for long-term investors.